There is a pattern forming in the silver market right now that I have not seen since some of the most explosive price moves in modern financial history. And if you've been watching silver closely, you already feel it, that low hum of tension in the charts, that coiling energy in the data, that sense that something is about to snap. Because right here, right now, as we head into this Monday, silver is sitting at what technical traders call a decision point, a convergence, a moment where multiple systems, charts, fundamentals, institutional behavior, and global macro forces all align simultaneously and point in the same direction. These moments don't come around often. When they do, the traders who recognized them early walked away changed, and the ones who hesitated spent the next several years wondering what they missed. So let's talk about what's actually happening, why Monday matters, and what this setup means for the months ahead. First, let me give you the foundation, because if you don't understand what silver really is, not just as a shiny metal, but as a financial instrument with industrial muscle and monetary legacy, then the setup won't make complete sense. Silver is the only asset on the planet that serves triple duty. It's a precious metal, a safe haven currency alternative, just like gold. It's an industrial commodity used in everything from solar panels to semiconductors to electric vehicle batteries. And it's what traders call a high beta play on gold, meaning when gold moves, silver tends to move faster and farther in both directions. That dual personality is exactly what creates these explosive setups. And right now, all three identities are firing at the same time. Let me show you what I mean. On the monetary side, silver has spent the better part of recent years being ignored while gold grabbed all the headlines. Central banks around the world were stacking gold at record pace. Institutions were buying. Governments were discussing de-dollarization strategies. And while that was happening, silver was quietly compounding a structural problem that most mainstream financial media never bothered to explain. The Silver Institute, which is the closest thing silver has to an official accounting body, confirmed that we are now in our sixth consecutive year of structural supply deficit. 6 years in a row where global demand for silver exceeded every ounce that came out of the ground worldwide. 6 years. And over that stretch, the cumulative shortfall has grown into the hundreds of millions of ounces. Physical silver that was supposed to exist on paper simply isn't there. And markets, eventually, always reconcile paper promises with physical reality. Now, before I go any deeper into this, let me say, if you're watching this and you've been thinking about protecting your retirement savings from all the chaos happening in the world right now, check the description below. I put together a free guide that lays out the saving secrets that thousands of American retirees are quietly using to protect their hard-earned wealth. It takes about 15 minutes to read, and it could change how you think about your money. Link is right there in the description. Go check it out and then come back, because what I'm about to show you is important. Okay, back to what's happening right now and why Monday has traders paying close attention. Here's the setup at the technical level. Silver had an extraordinary run over the past year. We're talking about a surge that eclipsed anything since the early 1980s in percentage terms. The metal more than doubled from where it was sitting just 12 months ago. That's not a small move. That's a generational repricing of what silver is worth in a world of monetary instability and industrial urgency. But here's what always happens after a vertical run like that. Even in the strongest bull markets, you get a shakeout, a correction. The market has to breathe. Weak hands get flushed. Leverage gets cleared. And then the true buyers, the institutional players, the smart money, the central planners who actually understand what's coming, they step back in at better prices. That's exactly what we've seen over the past few weeks. Silver pulled back, not because the story changed, not because the deficit disappeared, not because the demand evaporated. It pulled back because that's what markets do after vertical moves, and because a few macro factors created temporary headwinds that the algos and short-term traders used as an excuse to take profits. What were those headwinds? Two main ones. First, the Federal Reserve signaled that it was still considering the option of raising interest rates. When the Fed talks hawkish, real assets get sold. That's a Pavlovian reaction baked into modern trading systems. Computers see Fed hawkish, and they automatically unwind commodity positions. It doesn't matter that inflation is still a structural problem. It doesn't matter that the purchasing power of the dollar has been eroding for years. The algos don't think in years. They think in milliseconds. And second, there was a geopolitical development involving US-Iran tensions and an interim agreement around the Strait of Hormuz. That created a brief window where risk appetite increased, energy prices moved, and some silver traders rotated out of defensive positions. Short term money looking for short term trades. But here is what those sellers didn't account for: the gold silver ratio. Pay attention to this because it's the most important number in the precious metals market right now. The gold silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, across centuries of market history, that ratio has averaged somewhere between 15 and 20, 15 ounces of silver to 1 ounce of gold. That was the natural ratio in nature, how these metals are found in the Earth's crust. But in modern financial markets, manipulated by futures contracts and paper claims that have almost no connection to physical supply, the ratio ballooned. It spent years at 40, 50, 60, even touching 80 and 90 during moments of peak financial crisis. Right now, that ratio sits around 61. And if you understand what that means, it should make your pulse quicken. Silver is still massively undervalued relative to gold. Even a partial mean reversion back toward historical norms would represent a dramatic repricing of silver that traders who are positioned correctly would benefit enormously from. JP Morgan, not exactly a firm known for being excitable about precious metals, has a year-end average target on silver that represents meaningful upside from current levels. The LBMA consensus among professional traders and analysts points in the same direction. Goldman Sachs is on record calling silver vital to the green energy transition. These are not fringe voices. These are the same institutions that move markets. Now, let me take you back in time for a moment, because I think history is the best teacher here, and the parallels are too striking to ignore. In 1979 and 1980, the Hunt brothers, Bunker Hunt and Herbert Hunt, oil billionaires from Texas, made one of the most audacious bets in commodity market history. They started quietly accumulating physical silver, not paper contracts, not ETF shares, actual bars of silver in actual vaults. They accumulated hundreds of millions of ounces, and as their position grew and as word spread, other buyers piled in. Silver went from single digits to just over $50 per ounce in a matter of months. Now, think about that in context. This happened at a time when inflation was raging. The US dollar was under enormous pressure, and geopolitical instability was widespread. The Iranian hostage crisis had just started. The Soviet Union had just invaded Afghanistan. Sound familiar? The circumstances that drove the Hunt brothers' conviction about silver are not ancient history. They are a mirror of what we are living through right now. The Hunt brothers eventually lost their bet, not because they were wrong about silver, but because the COMEX changed the rules mid-game. The exchange raised margin requirements dramatically and restricted silver futures to liquidation-only orders. In other words, you could only sell, not buy. The rules were changed to crush a trade that was winning. The silver market collapsed not because of supply and demand reality, but because of institutional interference. And even then, even after the rules were changed to deliberately destroy the position, silver took years to fully unwind. That's how powerful the underlying fundamentals were. What traders who study history understand is that the suppression of silver prices through paper markets is not a permanent condition. Supply deficits are real. Industrial demand is real. The green energy transition requires more silver than the planet currently produces in any given year. The US government has designated silver as a critical mineral. That's not marketing language. That's strategic national security language. When governments start using words like critical mineral, they're telling you something important. They're telling you they're worried about having enough of it. And the modern COMEX mechanics, which most retail investors never bother to understand, are actually more fragile than they've ever been. The ratio of paper silver contracts to actual deliverable physical silver in COMEX warehouses has stretched to extremes. We're talking about dozens of paper claims for every single ounce of real metal. For years, that imbalance didn't matter because most traders never actually asked for delivery. They rolled their contracts, settled in cash, and moved on. But that's starting to change. Asian buyers, particularly in China and India, have been increasingly demanding physical delivery rather than cash settlement. When you start pulling physical metal out of a system that was designed on the assumption nobody would actually do that, the math starts to break down very quickly. This is exactly what happened in the London gold market in the late 1960s, right before the gold pool collapsed and Nixon eventually closed the gold window in 1971. The system worked fine until people started calling the bluff, and once they started, there was no putting the genie back in the bottle. Gold went from $35 an ounce when the gold window closed to $850 by 1980, a 24-fold increase. Silver went from under $2 to over 50 in the same period. The trigger was the breakdown of a paper system that had been suppressing the price of real assets, and when it broke fast. Now, here's what makes the Monday setup particularly interesting from a purely technical perspective. After the recent pullback, silver is sitting at a level that multiple independent technical systems identify as significant support. Fibonacci retracement levels from the prior rally, previous resistance zones that have now flipped to support, volume profile analysis showing strong accumulation at these price levels, meaning informed buyers stepped in heavily as price fell here. The RSI had gotten deeply oversold, a condition that historically precedes sharp reversals in trending assets. And the Commitment of Traders report, which tracks what the large commercial hedgers are doing in the futures market, showed commercial short positions at their lowest levels in recent memory, which sophisticated commodity traders know is often a precursor to a significant move higher. All of this is converging as we head into a new trading week. The pattern has a name among technical traders. It's called a coiled spring, and right now, silver looks like it has been compressed. I also want to talk about something that doesn't get enough attention in silver discussions: the role of currency dynamics. The US dollar has been under pressure from multiple angles simultaneously. De-dollarization efforts by BRICS nations are no longer theoretical conversations in academic journals. They're active policy decisions being implemented in bilateral trade agreements around the world. Russia, China, India, Brazil, South Africa, Saudi Arabia, these countries are actively working to reduce their dependence on the dollar for international trade. And when the dollar weakens or loses its privileged status as the global reserve currency, hard assets, particularly precious metals, tend to appreciate dramatically. Not because they changed, but because the measuring stick changed. Think about it this way. If you have a yardstick and you use it to measure silver, you get one number. Now shrink the yardstick. The length of silver didn't change. Silver itself didn't change. But your measurement tool got smaller, so the number you read off goes higher. That's what dollar debasement does to precious metals prices. And the rate of dollar debasement, measured by money supply expansion, by deficit spending, by the accumulation of national debt, has never been higher than it is right now. The arithmetic is not complicated. More dollars chasing the same amount of silver means higher silver prices. That's not a prediction. That's just math. Here's a specific story I want to tell you that illustrates what's happening at the institutional level right now, because it's more revealing than any chart. A few months ago, a major European pension fund, we won't name names because these institutions don't publicize these moves, quietly shifted a meaningful allocation of their portfolio into physical precious metals, including silver. They didn't buy ETFs. They took delivery of actual bars. And when asked about the rationale internally, the reasoning was this: in a world where governments can and do freeze bank accounts, restrict capital flows, impose emergency taxes on financial assets, and default on bond obligations, physical precious metals held outside the financial system represent the only form of value storage that cannot be confiscated electronically. You cannot send a software command to seize a vault of silver bars. The Cyprus bail-in in 2013, the Indian demonetization, the Canadian trucker account freezes, the Russian oligarch asset seizures. Every one of these events reminded wealthy individuals and sophisticated institutions that assets held within the banking system are never truly yours. They are yours at the pleasure of the government. Silver stored in a vault you control is a different story entirely. And that's why I want to take just a moment to speak directly to those of you who are approaching or already in retirement. Because the setup we're discussing here isn't just about trading opportunities. It's about something much more fundamental. It's about whether the wealth you've spent a lifetime building is truly protected. The threats facing retirement savings right now are not hypothetical. Persistent inflation erodes purchasing power every single day, even when it doesn't make headlines. Equity markets that have been artificially elevated by zero interest rate policies for over a decade are now exposed to significant downside as monetary conditions tighten. Bond markets, traditionally the safe haven for retirees, have experienced drawdowns that were supposed to be mathematically impossible according to modern portfolio theory. And geopolitical instability, from tensions in the Middle East to great power competition between the US and China, creates the kind of systemic risk that diversification within traditional asset classes simply cannot protect against. A gold IRA, or more broadly, a precious metals-backed retirement account, is one of the most powerful tools available to protect against all of these risks simultaneously. It allows you to hold physical silver and gold inside a tax-advantaged retirement structure, combining the inflation protection and crisis resilience of real metals with the same tax benefits you get from your existing IRA or 401k. The rollover process, when done correctly, triggers no tax penalties. The metal is stored in an IRS-approved depository, and your retirement savings become something that inflation can't erode, markets can't crash, and governments can't freeze with a software command. If you're sitting on significant retirement savings and you don't have any precious metals exposure, I'd strongly encourage you to look into this. The description below has a resource that explains the mechanics in plain language. Now, let's bring this back to the setup. What we're looking at heading into Monday is a confluence that serious traders spend months waiting for. The fundamentals haven't changed. 6 years of supply deficits, explosive industrial demand from the energy transition, the gold-silver ratio still deeply favorable to silver. The macro environment is constructive. Dollar weakness, geopolitical instability, inflationary pressure, institutional diversification away from financial assets. The technical picture is setting up. Support holding, oversold conditions, smart money accumulation visible in the data, a coil forming on multiple timeframes. And the catalyst environment is loaded. Federal Reserve meeting decisions, geopolitical developments, COMEX data releases, and the beginning of a new trading week that will force directional commitment from the large institutional players. The 2008 setup that preceded silver's explosive move from under $10 to nearly $50 over the following 3 years had similar characteristics. In the teeth of the financial crisis, silver sold off hard and fast. Everyone who didn't understand the fundamentals panicked and sold. And then, when the Fed started printing money and the true inflationary consequences of the bailouts became clear, silver made one of the most spectacular moves in commodity market history. The people who bought into that panic, the people who understood that the sell-off was not a reflection of changed fundamentals, but a temporary dislocation driven by fear and forced selling, those were the ones who came out the other side with life-changing returns. We saw a similar dynamic in 2011, when silver touched nearly $50 per ounce again, before being aggressively sold back down through coordinated margin hikes at the COMEX. 5 consecutive margin increases in 8 trading days. 5. The market didn't move against silver because of supply and demand. It moved because powerful players decided the price needed to be lower. And yet, and this is the critical point, the fundamentals kept building. The supply deficit kept growing. The industrial demand kept increasing. The monetary pressure on fiat currencies kept intensifying. Price suppression can work in the short term. It cannot work forever. Physics eventually wins. There is also something happening right now in the mining sector that most silver analysts are not talking about loudly enough. Silver mine production is not responding to higher prices the way you'd expect in a normal commodity market. Usually when prices rise sharply, miners ramp up production, new deposits get developed, and supply catches up with demand within a few years. That's not happening with silver. Why? Because most silver is not mined as a primary product. Roughly 70 to 75% of annual silver supply comes as a byproduct of mining other metals: copper, zinc, lead, gold. So the decision about whether to mine silver is not really a silver decision. It's a copper decision, a zinc decision. Silver production rises and falls with those markets, not in response to silver price signals. That structural quirk of the silver supply chain means that even a dramatic and sustained rise in silver prices may not produce the supply response that would normally calm a market. The scarcity, in other words, is a feature of the system itself. Add to that the recycling constraints identified in the World Silver Survey, where recycling volumes have hit multi-year highs but are being choked by refinery bottleneck capacity, and you have a supply side that simply cannot expand fast enough to meet the demand building across green energy, electronics, medical applications, and monetary investment. Goldman Sachs has been explicit about this. Silver is, in their words, vital to the green energy transition. Solar panels use silver paste as a conductor, and there is currently no commercially viable substitute that performs at the same efficiency level. Every solar panel installed anywhere on Earth requires silver. As nations race to meet climate commitments by scaling renewable energy infrastructure, silver demand from this sector alone continues to compound. And that demand is inelastic. meaning it doesn't shrink just because silver gets more expensive, because the economics of the larger projects still work, and because there's no readily available alternative. The electric vehicle story adds another layer. EV charging infrastructure, battery management systems, and the vehicles themselves use silver in ways that the average consumer never thinks about, but that aggregate into enormous demand numbers at the industry level. Every percentage point of EV market penetration translates into millions of additional ounces of silver demand that simply didn't exist a decade ago. When you put all of this together, the technical coil, the fundamental deficit, the institutional positioning, the macro environment, the historical precedent, the structural supply constraints, the industrial demand compounds, and the geopolitical acceleration of de-dollarization, what you get is not a typical commodity trade. What you get is a convergence that traders and wealth preservation strategists only see a handful of times in a career. And here we are, sitting in one of those moments, heading into a Monday where the market is going to have to decide whether to resolve this coil to the upside or attempt one final shakeout before the real move begins. My analysis says the bulls have the evidence. The bears have only short-term headwinds that are already known and largely priced in. The asymmetry, meaning the potential upside relative to the potential downside from here, is as favorable as I've seen it in years. That's not a guarantee. Markets can and do behave irrationally for extended periods. But if you're a trader who understands setups, you know that favorable asymmetry is all you can ask for. You manage your risk, you size your position appropriately, and you let the fundamentals do the work. There's a reason the most sophisticated wealth management operations in the world have been increasing their precious metals allocations steadily over the past several years. There's a reason the central banks of China, India, Russia, Turkey, Poland, and dozens of other nations have been accumulating gold and silver at historic rates. There's a reason that when you walk into the largest coin dealers in major American cities, the physical inventory has been noticeably tighter than it was just a few years ago. Smart money has been preparing, and the story is just starting to get interesting. Whatever you decide to do with this information, whether you're a trader watching the technical setup for a near-term opportunity, or an investor thinking about long-term wealth preservation, or a retiree who wants to make sure the savings you've spent a lifetime accumulating are actually protected from everything the world is throwing at us, the setup right now in silver is one that demands attention. The Monday coil is forming, the catalysts are lined up, the fundamentals are the strongest they've been in a generation, and history is rhyming in ways that should make anyone who has studied these markets very, very alert. If you've made it all the way to the end of this video, I appreciate you genuinely. Not many people have the patience and discipline to get this deep into a market analysis. And for those of you who stuck around till the end, there's something special available. When you check out the free guide in the description, if you reach out and mention that you watched all the way through, you'll get access to an exclusive one-on-one educational web conference, completely free, completely no obligation. It's a personalized session designed to walk you through the specific strategies that apply to your situation. This is only available to American retirees who have at least $100,000 in any type of retirement account. Not because we're being exclusive for the sake of it, but because that's the threshold where these particular strategies start to make the most meaningful difference. The guide in the description is where you start. Go check it out. Stay alert. And I'll see you in the next one.